George, thanks so much for joining us today.
Thanks for having me.
Yeah, really glad to have you here. I saw you getting into the steel drum music, which, everybody's aspiring to have a quality vacation, as things get back to normal. So I'm glad to see you're getting into it.
It was a little, if I'm not mistaken, it was steel drums to red wine.
Exactly, right?
Yeah. And is that like, I don't associate that with Gloucester as much as I do, I guess, a vacation, to your point. But yeah. It's pretty funky there in Gloucester, right?
It is. It's a little bit of an art scene here, and we've in the 4th of July parade. There's actually usually a steel drum band in it. So
nice.
But I was also the victim of not being able to go on vacation to the Cayman Islands due to COVID. So I still haven't recovered. That was an April 2020 trip that still was on the to-do list. Yeah. So. In any case, really appreciate you joining us. Thank you so much for everybody that's taking the time to dial in and tune in to George and hear us chat about what's happening in the world of WorkTech and investments in our sector. I think it's one of the reasons why we felt like it was really important to get some of George's time and share that with clients and colleagues and prospects is just that there's so much action happening. And I think that as people are making decisions on technology investments, it's something that, sometimes they really hear like the nitty gritty sales perspective and think about their own challenges that they're trying to solve. And sometimes they forget to step back and take a look at the macroeconomic situation on what's happening. So we're excited to have you on, George, and share some insights and give people the opportunity to ask questions. And so I'll turn it over to you, and you can jump in, and happy to help any way I can along the way.
Cool. Well, like I said, I'm really happy to be here. People, I'm going to say it, Neil. We go back like what is it? It was is it 25? How many years is it now? 20?
It was 1996.
Yeah. Okay.
So 25 years. Yep.
Right. And for this crowd, I was running recruiting at a what we used to call internet startup in Cambridge, Massachusetts, and open market. And Neil joined as one of the senior members of the accounting team, right?
Yes, that's correct. Yep.
Yeah.
Yep.
Yeah. And so. And here we are, full circle, all these years later.
Crazy candidate and recruiter talking about macroeconomic right. TA marketplace. So, yeah.
Right. But it was technology then, and it's technology now. So, all right. Well, that said, I'm going to go ahead and share my screen. And Neil, please do jump in and let's keep it a conversation. But because I have numbers to talk about. I've only got a few slides. You're seeing the follow the money WorkTech?
Yep.
Okay, very good. All right. So this is to date, and things are moving so fast that as I review these numbers, I just want to stress that I'm aware of at least a dozen more deals that are going to happen before the end of this month that'll update these numbers. So that's the plus. So I'm sorry, this is Q2 actually of 2021. We're well over 3.8 billion with 67 deals. That's just this quarter. And I'll let you we've already had, and we've got over a month left to go. We've already had the biggest quarter ever. Which is just, for me, just crazy given that, given the pace that we've had even through the pandemic. So I'll pause there, Neil, and see if you've got any thoughts or.
Yeah, I think that we've, from as a recruitment advertising agency and a consulting partner to our clients, I think that we're just seeing, as things have come back after COVID, we've just seen so many options, being presented to customers in the marketplace. And I think it's overwhelming. And, so I think that what we're seeing, what you're seeing on the economic side is definitely filtering down into, clients asking, hey, have you heard of this? Have you seen this? Have you heard of that? So I think all this money coming in is just fueled massive legions of sales teams for new stuff. And I think that's rolling downhill to us.
Yep. Yeah. I always lead with sort of like what this is, what the number is. That's what people like to follow the money. So I like to put that right up front. We've got a little more slicing and dicing, but now, stepping back and narrowing in on the market opportunity and really just the TA Tech global market opportunity. I'm looking at, I continue to expand my total addressable market numbers. It's now 9 countries. It's driven by my advisory clients. So I work with tech providers as well as employers who are looking to understand how big the market is, and this is the total addressable market built on a price per employee per month, 12-month value model, which is the way most of the tools and systems are sold today. It's vetted constantly. And I've got 9 countries here and expanding. So the TA Tech global market, I put just over 100 billion. This is made up of both platform technology as well as ad tech. And what happened a few years ago, my TA Tech number is bigger than most because I'm looking at that ad tech spend. So you've got platforms like programmatic and other distribution and market, purely ad technology, as well as service technologies that are replacing what used to be service providers. And so I break those two numbers up, and it's about, as I said, about 40%, about 40 billion or so is on the platform side. The ad tech side and that service tech side is really, it's a much bigger number, but a percentage of that does go into, if you're in programmatic, for example, there's a bit of a float there, if you will, based on what's going out to the different destinations. So at about 32% of the market being the serviceable addressable market, meaning TAM is like, if everybody who's a potential in the different categories and different market segments, if we looked at this, what would the market be? The total addressable market, the serviceable is, sort of the available market at any given point in time. And that runs around 32% on an ongoing basis. And that puts the serviceable addressable market at 32.6 billion. And that brings the platform tech into, 12 to 13 billion. So that's a little bit, that probably sounds a little bit more in line with numbers people are used to hearing.
Gotcha. When you mentioned the specific countries, what countries are included in those numbers, George, just so people can start thinking outside the U.S. and kind of prioritize based on how you've looked at the market? Okay.
So let me see if I can do it off the top of my head, and if not, I'll pull up the spreadsheet. But the U.S., of course, that's by far the biggest market globally currently. And I do have Australia included there. I've got UK, France, Germany, Switzerland, Austria, Spain, and Ireland. And Germany, Austria, and Switzerland make up the DACH region in Europe, and behind the UK and France, that DACH region is showing a lot of growth, and a lot of the tech providers, a lot of the investors are looking at that region very, very closely. And I don't have the global breakdown, but at the end of the quarter, I do the full look back report. But I can tell you, going through all of the deals, it's always, highly skewed to the U.S., but I'm seeing deals coming from all around, all over the world. It's just a really good time to be in HR tech, work tech.
Very cool.
Okay.
Yeah.
Cool. All right. So again, to sort of break it down on the investment side, the one thing that the pandemic did, and the impact that it continues to have is, I would say, close to 800 million in investment going into talent acquisition is still a big number, but there used to be pre-COVID more of a balance between sort of core HR and HCM and talent acquisition. The talent acquisition category has taken a hit, and talent management has also been boosted. So when we look back over the last, I look at my data going back 5 years, and then when I look beyond that using more public accessible data from different sources, you would usually see HCM and talent acquisition sort of at the same total dollar volume. But and HCM has always had a larger deal size or average deal size as would talent management. But again, these are still massive. No matter how, I remember when 800 million was a big quarter period for all of WorkTech, right. And it wasn't that long ago. So this just puts it in perspective, if you will.
Do you think that? I guess as we look at like HCM in total versus talent management, and that larger deal size on talent management, is that a factor of just fewer players in the industry, or it requires a bigger investment to provide solutions in that marketplace? I'm just curious about talent management. We're always on the front end of the talent acquisition side, but whenever we go to some of the conferences, they're kind of coupled together. So I just want to make sure that people maybe thought about that a little bit, and you can provide a little insight there.
Yeah, I think the first thing I would say is while I look at these numbers, we're looking at this number quarterly right now. A quarter does not a trend make, right? Especially with investments. But the ratios here are consistent through the entire pandemic. So, we're like 5 to 6 quarters, and it's been very consistent. There's never been a slowdown in investment. So that's the first thing I would say. To answer your question directly, in any given quarter, you'll see in any of these categories, you'll see 1 or 2 big deals that can really, boost the category. But that's consistent quarter to quarter. So, I put Eightfold, that's one of the notable deals this month. I put that in talent management because they're really, while they started in talent acquisition, and with their first round, I would have had them in talent acquisition. The last 2 rounds have been talent management because they're really extending into internal mobility and talent management oriented. They're becoming more of a platform play in that regard. So that's where I put them. But it is, I think it's the categories are falling in on each other. So I'm seeing, learning on the job board marketplace in that world. And that is, these are models where we're grooming a talent pool or creating a talent pipeline and credentialing skills, teaching the skills. There's some really interesting things happening where to some degree the categories are getting really blurry between each other. And the whole discussion of categories is really, we can't have a meaningful conversation about what's happening in the market without it. But the buyer is looking to solve business problems. They don't really care which bucket we put the vendors in, if you will, the user of the technology, right?
Yeah, and I feel like it feels like 100 years ago that LinkedIn made that purchase that got them into the learning space, right?
Linda, yeah,
right.
Yeah.
And then between them grabbing Linda and then them getting bought up by Microsoft, talk about just when you talk about mashing those categories together, right? Like it's a whole hot mess. Do you think people are trying to mimic some of what Microsoft and the bigger companies are doing, or is someone like Eightfold just opportunistic? Like they've got momentum, they've got a modern platform, and they're just kind of jumping on opportunities and expanding what they're doing. So,
everyone's taking advantage of some kind of market opportunity. So, there's always that. I think my perspective on Eightfold. They've raised a ton of money. They've got a valuation that's, over $2 billion now. They they have to go on, maybe if they were opportunistic, it was, capitalizing on the trends to raise money and get to that valuation. I have a difficult time, given what we know about the market for the last, 20 years. I have a difficult time seeing any vendor in the talent acquisition and talent management platform play arena deliver on a valuation like that. That's hard. It's hard for me to see that. It demands that they become something more, for sure. I think they're going to start coming for ATS platform customers. They're showing up in a lot of deals like that already. They have customers that are really putting and this is, I'm talking to their customers. This is not based on any, while I have gone deep with them on their product a little bit, this is based on what I'm seeing at customers that have put Eightfold in front of like a Workday, and they're relegating the ATS to like a back office filing system. And Eightfold looks like an ATS to me in that environment, and as well as showing promise for talent management. So you can't get to that. You can't deliver back to your investors without probably even extending further. So I wouldn't be surprised to see them look even deeper into the talent management and talent acquisition category stacks and make some acquisitions or drive their native capabilities in those directions. They just have to. And I think it's a really interesting spot that they're in right now, because they're sort of dependent on having good partners with like Workday and iCIMS and Smart Recruiters, and Greenhouse is coming up into that world as well. So it's an interesting one that you bring up. It's a can of worms.
Yeah, right. And I think that just as people are looking at all these dollars, again, in one quarter going into, HR tech, when we talk about VC dollars and a company gets valued at X amount, just for people who don't follow the investing scene, what does the VC expect to get back? When you mention a company, let's say a company's valued at $1 billion or $100 million, and a VC puts in $1 to contribute to that valuation, what do they have to get back for a successful exit?
Well, the rules of thumb are, you look at the money that's been invested, and most investors want to see like a 5X. And that's where that is the number, right? That's usually what's driving that multiple drives the valuation. So, it doesn't, now, Eightfold has had momentum and they've signed a number of logos. But the valuation is a prediction. It's a forecast. And when you, that's where you start to realize they've invested money and they've taken a percentage of ownership based on the money they've put in and the value of the business. And that's generally the rule of thumb. The two big rules of thumb we talk about a lot, or I talk to people about a lot, are that sort of 5X general ballpark from dollars invested to return, where they need to get to provide a good return. And then it's still very true that only 10% of the companies that walk this path are successful. Now, success is a relative term, right? If you're let's not. I don't want to pick on Eightfold here. They've got a lot of nice people over there that are working really hard. But if you've raised, let's say you've got a $1 billion, you're a unicorn. You've got $1 billion valuation. You've raised, $300 million, and you're looking to get to 1 to 1.5 billion. You can't get there. Let's say you got to 800 million. An $800 million software company or company selling for that much, that's a good number, but it's not a success for those investors. Now, what can happen is those investors can pull out. Those investors, the well can run dry. if your revenues aren't at the run rate where they need to be, what you end up being acquired for can be much lower than, and it feels like a failure, and it may take the wind out of your sails from a go-to-market perspective. But you've built something with customers who it's the saddest story because it was just overvalued and sort of pumped up in that environment. Whereas a much smaller company who's profitable and giving a return to investors and maybe getting acquired for a large multiple, that's a success. A company that has happy customers, is profitable, and is growing, that's a success, right? So I think we need to be careful not to celebrate the valuation and the money raised, but look at what companies actually are delivering to the market, to their customers, and what they're able to sustain.
Sounds good.
Yeah. Sorry, I went off on a rant there, but
no, it's all good. I think that some people see the numbers and it's headlines, and it's hard to turn it into practical terms of what it means to them as a customer. And I think that with those big dollar raises go really high expectations. I've been in a couple, VC-backed HR tech companies, and and again, much more modest rounds. 13 million, 5 million. But the expectations are still the same from those investors that they need to get that 5x or even 10x like their expectations, and not everyone hits. So,
right.
And I think that for the end clients, as they're thinking about a tech stack, making sure that they know which bets to make. So when they hit on a return, it's typically because the customers are actually, giving them a lot of that momentum. So,
yeah, I think, the market's going through a bit of from a buyer's perspective, from the customer's perspective, we're coming back full circle now around these issues because of these valuations, because of what's happening in the market. So what I mean by that is back in the day when I was taking Brass Ring to market, this is 99, 2000, 2001, we're growing like crazy, but it was unconventional in the sense of how we raised the money. It came through what would be now corporate funds, and we had we had Excel partners in the mix as well. But we had to spend a lot of time talking to prospective customers about why they shouldn't be nervous about working with a high growth startup at that time. Then that really went away, for the most part through the 2000s. It's more of a checkbox in the RFP in the enterprise market, and it might not come up at all in the SMB or the middle market in their process. And I think now, from what I'm seeing, working both with the tech providers and the customers, is a little more due diligence is coming into creeping back into the process around, what's your burn rate, what's your overall investment. You're getting the CFO involved in looking at the how solid these companies are, and I would highly recommend that with anyone looking at a startup, because it's easy to get sucked into the hype, but until you've reached a certain level, there's really you really need to dissect the numbers to because if they're burning their cash quickly, it's going to start to impact product roadmap, customer support, and their existence long term. If you look at, I'm going on another rant here, but I'll keep Brass Ring as the example. Brass Ring had a great product circa 2002 and had, over 50% of the Fortune 500 on their platform. But when the investment dried up and then there were acquisitions with Connexa, IBM, it's sort of, they're still out there, but the product is largely unchanged from that time frame. And it's sort of like, what happened to them? Where did they go? And they still have customers who are eking along for whatever reason with, features that haven't really grown in the last 15 years. And that's an example of the downside.
Yeah. Yep. Makes sense.
Yep. So I thought there's so many deals to talk about, but just this quarter, we already hit eightfold. The thing that I'm seeing on what is the left side of the screen, these are all marketplaces, job boards that are starting to come back. Now, what I would tell you is that since I've been tracking this, and I think I have the most thorough list of talent acquisition or any HR technology in the space. What surprised everyone, it surprised me in 2017 and every quarter after until I realized, that I was looking at it wrong, is that while we thought job boards and marketplaces would wane off and sort of like the rumors about their death were greatly exaggerated, this category is the leading category, bar none, for the last 5 years in work technology, and I believe even prior, but my detailed data doesn't go back further than 5 years ago, and the pandemic certainly put the brakes on for a quarter or two, and we're seeing some really interesting deals there that have to do with Malt is around, and Malt is around the contingent workforce, or what I like to call the independent workforce, so contractors, freelancers. WorkRise is used to be RigUp, and they're in the we're talking about I don't want to, like, blue collar used to be the term, but they came from oil and gas, and now they're more largely going after job cases market, if you will.
The skilled trades.
Skilled trades, right. Sorry, tip of my tongue.
Good, yeah. Okay.
And then Ripple Match, more of a AI matching, and so the deals are interesting, and there are other marketplace deals, smaller deals that we've seen, but I think that's don't count them out. And as we look at the sort of we're in this next wave of talent acquisition technology and talent technology, you'll see more models that are doing interesting things around, as I mentioned, learning and skill certification, and creating more pipelines of early career and certified talent, if you will, based on different skills or disciplines or career paths. You've got employers like Microsoft and Google investing in or contributing into places like the Make School that have a tech curriculum in the Valley, and then what a great talent pool for internships. An internship, what a great what a great case study for someone to make a hire from. And I'm seeing that in healthcare. I'm seeing that in even sales. So we're going to see a wave of really interesting stuff here. I've got a couple diversity and inclusion oriented deals later that are emerging. They weren't the biggest deals, but and some other categories as well. I think this is an interesting space to keep an eye on still. And then because of talking to you, Neil, I brought in, Phenom and Handshake from a recruitment marketing perspective. Those were a couple of other big deals, two other unicorns in the talent acquisition space that achieved that status in this last quarter.
Gotcha. Yeah, I mean, every one of these vendors is someone that we're starting to see come up a lot more. I mean, I think we've seen them around longer when they have the further down the alphabet, right? Ripple Match, we're starting to see less of, but as people look at this, Series A, just follows sequentially, right, George? Series A is the first round, and Series E means that's the fifth round of investment. So, those are folks that are, have proven enough to the marketplace that they warrant getting those bigger investments to try and, push them over the edge.
Yeah. There's no standard to it. I'll see it goes, seed, and then it follows the alphabet, A, B, C, D, E, right? Then you get into private equity, and there's debt funding and other ways to, bring cash into the business. But when I say there's no standard to it, I'll see a $500 million or $500,000. I'm sorry, $500,000 seed round, but I could see a $500 million E round. We've seen stuff like that. Or I could see a 50 million E round. It's about the it's about the number of rounds, and about it really has more to do with the way the current and new investors are looking at the tech provider and just managing through these rounds. So you could be at Series E and someone has raised 100 million or 200 million, or you could be at Series E and they've raised 500, 600 million. There's no standard to it.
Yeah. And do you think, just in looking at the HR tech market, I mean, there's lots of VC money flowing into other industries and other markets. If you were indexing HR, or WorkTech versus, other industries, is it over indexing for higher investment? And I don't know if you follow those others, but just kind of your general sense of it, is it a favorable place to put money right now compared to other industries?
I think it's a favorable place to put money right now because of what's happening to work and what's happening to the workplace. In order to present you with these numbers and do what I do quarterly and annually, I do see a lot, but I'm not tracking the rest of the VC. So there are some sources for that, like CB Insights or PitchBook and others that have a good sort of general B2B or B2C view of the world, but we're still a little nuanced. And so there aren't a lot of folks that track this the way that I do. But there was an article today that I put out. I didn't write it. I shared it in Talent Product Plays, our Facebook group that most folks in the industry participate in. And it talked about how the engineering talent in Silicon Valley is moving into collaboration and all around, work collaboration, and startups that are focused there because there's just so much going on, and there's a lot more in the pipeline. And it's I think there are a lot of folks looking at new regulations that are coming down that are forcing large enterprise and anybody who is competing with large enterprise customers, large enterprise being employers that would have 10,000 employees or more, up into the hundreds of thousands of employees, middle market being 1,000 to 10,000 employees, and then SMB being beneath that number. If you're in that large enterprise and you're trading, publicly, you've got regulations that are now from the SEC and that are asking you to report on your human capital interests in a way that is not just demographics. Like it's a narrative, a fact and database narrative that you'll have to tell. If you're telling that story about diversity, inclusion, equity, or as you begin to tell that story, that becomes an employer brand story. And then everybody needs to have that story in order to compete with you for talent. So there's a lot happening there. Then there's the hybrid work model that everybody's confused about right now. What does the future look like? There's a lot of both compliance and pain-based issues, change-based issues that are driving a focus on this category.
Very cool. Yeah, there you go.
Yep. So the emerging stuff that I talked about in the DE&I space, it's still disappointing how little money is going into providers that are focused on that, given the commitments that were made broadly about investments that would go toward, diversity, given the commitments that are broadly made around diversity. Now that said, I know a lot of the platform players in talent acquisition are investing in their roadmaps around diversity, but that doesn't make up for the fact that there are very few deals coming through. I don't think there are very few ideas. I think there are a number of folks, developing products and interested in, seeing funding. But it is a place where, because of as the technology advances as these regulations that I talked about and the buyers become more mature and understanding what they really need, I think we're going to see a big, just my opinion, a big push there in the next year. I'm hopeful for that. We continue to, I think how the pandemic has put a light on the independent workforce. And I'm not talking really about the gig economy, but freelancers, temp workers, contractors, and we're now at a place where about half of the American workforce has worked as one of those in their career. And I think we're rapidly moving toward that 50%, that sort of 50-50 independent worker to full-time employee. And as we're looking at uncertainty in the market and difficulty hiring people, I think that's just going to get even more leverage. So we're seeing not just sources of talent there, but also sort of new modern vendor management systems or systems that empower line managers to hire and manage that type of workforce while being compliant and paying on contract and things like that. So there's a lot of interesting stuff. There's more emerging stuff, but I thought for this audience, those were two places to pause.
We've seen a lot of staffing firms make investments in technology. Does that mirror up with this kind of management of the independent workforce? Do they, are they making moves so they stay relevant? Or are they, what's your take on how really some of the bigger global staffing firms are, some of them have their own kind of innovation funds and invest in these players? Like, what's the role of the large staffing firm at this point? Are they under siege? Are they well positioned? Are they being aggressive? Just your take on that would be great.
Yeah, I think large staffing firms are, they're pretty diverse, right? In their what they bring to the market. So along with the traditional contract and contingent staffing models and temp staffing models, they are really the leaders in recruitment process outsourcing as well. And in that seat, they have an incredible bird's eye view on the technology and what's working across all of their customers. And the RPO model, when it came out when it really started to emerge in the late 90s, early 2000s, the vision was, one platform, we bring the technology and the expertise, and the customer just fully, outsources. That didn't happen. It happens sometimes, but customers have spent $1 million on a platform for talent acquisition and or talent management. They want to leverage that investment, and they want the resources on top of it while leveraging technology from the RPO in different areas, maybe their ad distribution or marketing capabilities, screening, selection. So it was really not a surprise when like a Randstad rolls out a corporate investment fund and starts to, because they're seeing, they were really early in implementing, new platforms and implementing, AI and conversational technology. So they were really A/B testing within their customer base or even within a customer. So I think that being said, that's one part of the profile. The other side, though, is that in that RPO space, it's really becoming so tech forward, right? So the technology has advanced so rapidly that if you're thinking about taking the transactions off of the scheduler's desk and administrative transactions off of the recruiter's desk and providing a better candidate experience with a conversational interface, that has a direct implication for RPOs. So you've got companies like AMS who actually went full on and hourly with their product called Hourly with an end-to-end hiring platform. So they're now selling technology alone while they're also selling RPO and staffing and other services. And I think you're looking at, there's a partnership between Cielo and Smart Recruiters. That's more of a partnership. But I think, Cielo has always invested in technology and always been right on the forefront with different technologies. And I think you'll see some interesting things evolve out of that partnership over time. And it's just, so I think that answers your question. I think it's yes, yes, yes. They're smart investors. They've got a good eye on the market. And I think they'll continue to evolve and become more and more, tech forward. But there's always going to be a place for recruiters and those relationships and what they provide for candidates and employers.
Very cool. Thank you.
Sure. So this just sort of puts it in perspective. I hadn't updated this with the latest numbers, but so we've already had the biggest year in 2021 since it's been tracked, since it's been relevant to the conversation as far as VC investment coming into work technology. So it's a really it's just, there's so much happening and so much coming at the market so fast. It's mind-boggling, and I think the why you want to be looking at this. I actually don't start with the money. I start with the trends, and it's a little bit like the tail wagging the dog. If you're thinking about like what's the money, what's coming in. It's good to know what emerging technology is coming, but that should be driven, and for large part is driven by the customer's need. So that's why this is interesting to me, and I think for any of your customers, you want to have a handle on what's coming. If you're thinking about your tech stack, you're thinking about your strategy. You really want to have a strategy for dissecting this data and getting ahead of the curve on this stuff. And that's why I'm here, and most analysts provide that kind of view to this.
Yep, it's crazy.
Yeah, and that's all I have. We can go to questions and anything else you want to talk about, mergers, acquisitions, et cetera. But I'm at oneworktech.com, and that's where folks can find me. But I'll keep the data up there.
Yeah, it sounds good. I mean, this is really helpful. And again, our goal is to get people thinking about the bigger picture. I think a lot of times we get focused on our widget that we're looking at the time, or our particular, functional problem. And I think it's important to understand, what's happening in the marketplace. So I guess we've got a few questions here that are related to just recent M&A deals.
Okay.
JobBite do some interesting and funky things. We've seen, PandoLogic jump in, but maybe if you could just kind of talk about, JobBite's been around for a while, and they've done some, transactions over the last couple of years, and just get your take on that. And then again with PandoLogic, and I'd say the summer of 2019 was the summer of like programmatic, we called it, right? Like in Pando getting into a different space. So maybe talking through some of those acquisitions, and in the end, we want like a TA leader to know like, what should be on my radar when these things start happening.
Yeah. So, the interesting thing about acquisitions, a lot of folks, there's a common talk track that is like the market's consolidating. And it's true that there are usually, when you look at a market share pie chart, there are like 2 or 3 vendors that are clearly leading the market. They'll have anything larger than 10% of the market usually puts you into a leadership position. 20 to 30%, you're probably the top, the leader in any given category. But then there are, the pie is sliced up in, 2% and less slices, and there can be hundreds of these vendors. And our market is actually expanding. So when you look at the total addressable market figure that I shared earlier, those numbers are going up because things that service providers used to provide are now delivered via technology. Things that ad agencies used to provide are now provided via technology, and technology that agencies bring to the table or support. So it's the roles and the strategic responsibilities around the technology have definitely shifted. So the market's actually getting bigger. Yeah, the vendors are consolidating, but every time the CEO of Slack, actually, Butterworth, I think is his name, had a great quote. He said, he doesn't believe in market consolidation because every time there's an acquisition and a vendor, gets merged in with another, 10 emerging startups race in and gobble up what was there. And that's very accurate if you think about what's happened in our space. So I really believe as long as this market's expanding, the whole concept, it's not going to get easier to look at who are the 1, 2, 3 players or who are the players in the space. So I'll start there. When these things happen, there are a couple of reasons you might acquire. To simplify it, there are many reasons you might acquire another company. The one that you want to see I think as a user or customer is when somebody's extending their capabilities or bringing in resources that are going to help them with that. So they may be acquiring a product or a set of technology to fill a gap in their current offering. Good thing for a customer. They may be extending their product and then providing more value to the customers. Good thing. Getting a team with intellectual property that is really good at what they do, the product they develop, or supporting their customers. Good thing for a customer. There are other acquisitions that take place that are really confusing and overlapping, and it's not real clear, why this is happening. And that's happening really to gobble up revenue and market share and to feed that back into that valuation into that for investors. And it's a good reason if you're a buyer who's concerned about this to pull your CFO in or pull in your, whoever it is from your environment that whether it's out of procurement or legal, who would look at these types of numbers to help you navigate that. I'll pause there because I just, threw a lot out there. I know you want to get into some specific deals, but anything there that?
No, I mean, I think that I guess, as people are looking at those, what are the questions that they should maybe ask, when someone's going through an acquisition? I know that they happen for different reasons, but, if my vendor just got acquired, is there two critical questions? Bringing in the CFO sounds like a great idea because, a lot's riding on these platforms if they're onboarding or if they're managing their team and, if they're recruiting talent, it's a lot to be concerned about. So where do you think those things they should be asking with, as a UTA person?
Yeah, I think I would lean on the CFO to create like a financial health scorecard, and that should also be based on what amount of risk you're willing to take with a vendor partner, based on the burn rate, based on the cash they have on hand, based on their trajectory from a sales perspective. And I come from the startup world. I'm a advocate, so I really love, my whole career has been based on innovation around technology. So that's it's not a bad move to pick the right horse, as they say, that's going to get you further faster, and versus the carriage that might be stable, but it could be a bumpy ride and slower, right? So as far as getting you where you need to go. So I would lean on the CFO for that scorecard, but then I would look at, what's going to happen. What does this mean for my product roadmap, the capabilities that you're delivering to me that I'm counting on? What does it mean for the future of the product? What does it mean for support? What does it mean for, any changes around pricing or the financial model? Will there be any changes based on this transaction that are going to impact me? And I think those are the, product and support, issues. Those are the ones, especially if you're the customer of the one being acquired, you really want to understand what's going to happen here.
Yeah, it seems like that can be, well, I mean, one of the reasons why you typically go with that startup and the technology innovator is that, as a bigger company, you might have a lot of influence on what gets built in the product, right? I mean, that's always been a key factor on why a big company would take a risk. But if your vendor is the one that's acquired, there's going to be consolidation in some way, shape, or form. So how do we make sure that you're still getting the service level you expect and that pricing is stable, all things considered. So, I think that's important. One other thing, I think it was, is it Stack Overflow that just got moved into the private equity world?
Yeah.
Is that right? So maybe just, again, another kind of, we hear venture capitalists, we hear, like, what about private equity? What does that mean, to the company, to the customers? Like, what's your take on that?
Well, in many ways, it's an exit because the company's acquired when that happens, right? So I can't remember the number with Stack Overflow, but it was over $1 billion that was paid for Stack Overflow, and so that transaction happens, but then at that point, the relationship between private equity and the vendor, the tech provider, is a little more intimate than some VC relationships because they own the lion's share, if not all, of the business, right? But from the customer's perspective, it's really it looks like the investor. It is the money behind the business. There are, again, I'll simplify this. There are, I'm sure in the PE world, they feel there's a big rainbow of flavors of PE, but in the way I tend to look at it, you've got PE that's got a growth mindset. So they look at a Stack Overflow. I'm not intimate with their PE firm, but you might look at a Stack Overflow as a growth opportunity. And how do we work with this team to bring them to the next level, come up with a strategy to make some acquisitions, extend their product, their ecosystem of partners, et cetera. And then additional investments may be made to take that company to the next level. But then there's a different type of PE firm, which is the scarier kind, who comes in and looks at how do we, lower costs? How do we lower headcount? How do we get this company looking good from a balance sheet perspective to then take to the next transaction from a purely investor's perspective? And I'd have to say that for the most part, the players that are in this space that I've bumped into have been very patient. The private equity players. So it's been a while since I heard a tale of the kind of pillaging of a company to get it ripe for another sale. Yeah. It's more growth mindsets at this time, given what's happening in the market.
That second private equity firm style that you mentioned sounds like a house flipper almost to a degree, right?
Right.
Buy something, make some changes, dress it up, and resell it.
Yeah, but Stack Overflow is interesting because they're a great example of why I call it WorkTech now, right? Because they do have a job board, but that's not really what they do, right? They train and certify, developers, and then their PE firm also owns Udemy, which is an LMS, and they own Code Academy. Now, there's been no mention of a roll-up here, but I look at that and I think, wow, this private equity firm has made some really interesting strategic acquisitions and investments. And how does that integration play happen in their portfolio, or is there a roll-up coming, or how does that look? So that it's interesting. That's an interesting deal.
Yeah, and they're all part of the same family now, so they're probably sharing some, advice and advising on how to watch out for certain potholes and things like that. I think we see that with Indeed and Glassdoor, right? Part of the same family, doing a little bit of sharing, So, I guess we only have a few more minutes, so I guess I'll just ask, with all these big numbers and everything stacking up, is there a bubble? Like, will it burst, or will it keep on going? And 2021 is the biggest year ever, I guess. do you see a bubble coming, or is it, we've been through a couple of those together, right? So
yeah. We certainly have. I would say that things are so out of control right now that I really stopped making predictions a while ago, because I've been, I was nervous about a bubble and what would happen in the market and to our category before the pandemic. And then the pandemic hit, and it's out there. I said, don't overreact. We're probably going to see investment dry up for a couple quarters. It'll come back once we'll see we've got to get through the pandemic and the resulting, economic issues. And then my report the next quarter showed a bigger quarter than the one before, and so on. And so it just follows that trend. And now here we are. So I think there has to be an end to it. But I don't see that coming in the foreseeable future, because as I mentioned, what's happening in the space right now, there's so many legacy platforms that need to reinvent themselves to be a part of this next wave of work technology, talent acquisition technology. And what I mean is, everything's going conversational, everything's leveraging data and AI. Everything is putting the human being, whether it's a candidate or an employee, at the center. And most of the legacy platforms do none of those things I just mentioned at all or well. And so they need to reinvent themselves. And how they do that is they can do it organically in with their development pipeline. But it's much faster to make some acquisitions. So now we're talking about, the market's still expanding. Companies are getting absorbed by the platforms, and then they become a part of the "we don't do anything fast and can't do all things well" experience. So now the startups emerge. So I think we've got. I don't know how to put a number of months on it, but I think for the foreseeable future, I think we have a real need to solve these business problems for our customers. And we're going to see tech be a bigger and bigger part of that in this next wave. And so we're going to see funding and merger and acquisition activity that will support it.
Gotcha. Very good. Listen, we just have a minute or so left. So I just want to say thank you first and foremost for sharing your thoughts. And we know we can find you on recruitingnewsnetwork.com.
Yeah, that's right.
But just wondering, if people want to dig in more or talk to you, what's the best destination for them to hit to get in touch with George LaRoque?
Yeah, I go to the word one, worktech.com. And if you're used to finding me at any other URL, it all goes to the same place. So I'm on Twitter and I'm on LinkedIn. I'm happy to connect. And I've got a bunch of new stuff coming out here in the next couple of weeks, along with the quarter close. So it's a good time to subscribe. And I look forward to engaging with the community more.
Sounds good, George. Thanks so much for your time and your insights. It's been really helpful and a lot of fun. Good to see you.
Thanks. Good to see you.